Welcome to the Bull vs. the Bear, where we break down both sides of the story for today's hottest stocks. Today, we are tackling an absolute giant, Exxon Mobil. Just look at this number. In the last 5 years, Exxon Mobil has delivered a massive 324% total return to its shareholders. I mean, that's a powerful performance by any measure. But the big question on every investor's mind is, can this incredible momentum possibly last? So that's what we're here to figure out. Is this oil giant a truly resilient cash flow king that just keeps on printing money? Or is it a dinosaur, just waiting for the asteroid of a changing world to hit? We're putting Exxon under the microscope to find out. All right, here's how we're going to break it down. We'll start by setting the stage. Then we'll dive right into the bull case. Counter that with the bear case. And finally, we'll lay out the key price targets so you can make your own call. Okay, let's get into it. First up, the bulls. And from their perspective, Exxon isn't just surviving, it's absolutely thriving. They see a well-oiled machine that is firing on all cylinders and rewarding shareholders big time. The whole bullish argument really stands on 3 main pillars. It all starts with their world-class assets, which are super low cost to operate. Then you've got their incredibly disciplined way of managing money. And finally, there's their, let's call it, pragmatic approach to the energy transition, where they're focused more on things like carbon capture, instead of just pivoting hard into renewables. So let's double-click on those assets. The company is hitting record production, pumping out 4.8 million barrels of oil equivalent every single day. And look, this isn't just about volume. It's about highly profitable volume, coming from some of the best, lowest-cost regions on the entire planet. And the crown jewels in their portfolio? Without a doubt, it's their operations in Guyana and the Permian Basin. I mean, these 2 regions are absolute powerhouses, just consistently crushing expectations and driving growth. Guyana alone is churning out over 700,000 barrels a day, which is just a testament to what analysts are calling superb execution. This quote from an analyst report really nails their operational strength. What it's saying is that even when things get rocky, oil prices wobble or the chemical business hits a slump, Exxon has proven time and again that it can generate billions in free cash flow. That resilience is a cornerstone of the whole bull thesis. So what do they do with all that cash? Well, that brings us to the second pillar. They give it back to shareholders. It's a simple but really powerful cycle. They generate a ton of free cash flow, they use it to raise the dividend, for the 43rd year in a row, by the way, and then they buy back a staggering $20 billion worth of their own stock every single year. And here's the kicker. Despite this incredible performance and the massive shareholder returns, the bulls argue that the market still isn't giving Exxon enough credit. They believe the stock is undervalued, and they're pointing to the stellar execution and cash generation as proof that there's still a lot of upside from here. But not everyone is convinced. Let's flip the coin and talk to the other side of the trade. The bears see a very different picture, one that's filled with growing risks and long-term threats that could completely derail this whole bullish story. You might be asking, with numbers this good, what is there to even worry about? Well, the bears aren't necessarily arguing with the company's current performance. Their focus is on the horizon, and they see some serious storm clouds gathering that could fundamentally challenge Exxon's entire business model. The bear case really centers on a few key risks. First, you've got the classic problem. Oil and gas prices are just unpredictable. Then there's the elephant in the room, the massive global push away from fossil fuels. This creates the risk that their reserves become stranded assets, basically worthless, and that their own low-carbon investments just won't pay off. Throw in increasing regulatory pressure and the concern that their high spending might not lead to high returns, and you've got the bear case in a nutshell. And this slide really shows you the stark difference between the 2 possible futures. The bulls see free cash flow growing at a healthy 7% a year. The bears, they see that growth slowing to a crawl, maybe just 1 or 2%, as volatile prices and rising regulatory costs start to eat away at profits. But the biggest long-term threat, the one that's really existential for the bears, is this idea of stranded assets. I mean, think about it. As the world transitions away from fossil fuels, Exxon's most valuable assets, all that oil and gas in the ground, could become liabilities. They could become literally worthless on the balance sheet. And that is a huge, huge risk. So, you've got 2 compelling but completely opposite stories. Let's move to the numbers and see how this conflict actually plays out when analysts try to put a price target on the stock. So, taking a look at the numbers, most analysts see some decent upside from the recent price of around $115 a share. They're clearly acknowledging the company's operational strength. But you can see their targets vary a bit, and that just reflects all the different assumptions they're making about the future. Now, this is where it gets really interesting. When you model out these two distinct scenarios, the range of outcomes is dramatic. If the bulls are right and the company keeps executing with strong growth, you could be looking at a price target as high as $170. But if the bear case plays out, where growth stalls and risks pop up, the fair value could be closer to $105, which is actually below where the stock is trading right now. And that really brings us to the heart of the matter. Your own investment thesis, whether you're a bull or a bear, really depends on your view of these three huge unresolved variables: where oil prices go, whether Exxon can keep executing, and just how fast the global energy transition really happens. Which brings us to the final and most important question of this entire breakdown. It all boils down to this fundamental tug of war. For the bulls, it's about a best-in-class operator that is an absolute cash flow machine built to reward investors today. For the bears, it's about a legacy giant facing an existential threat from a world that is changing very, very fast. So, who wins? We've laid out the evidence for both sides, from the record production numbers to the massive risk of stranded assets. Now, we really want to know what you think. Which one of these scenarios do you find more compelling, and why? Drop your take in the comments below. Tell us, are you a bull or a bear on this one, and why? And hey, if you found this breakdown valuable, please do us a huge favor and hit that like button, and subscribe to the channel for more deep dives into the market's biggest debates. Thanks so much for watching.